Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets and the markets closely associated with the metals. And Miles, you have a lot of explaining to do. What's going on with gold? We took last week off, and look at what happens.
Yeah, that's my
got
fault.
All this activity.
Yes,
yeah.
My fault
You're
for
the
going to
chart guy.
Thanksgiving break, right?
You say that charts tell the whole story. So, tell us a story this week as to why we're sitting at $2,045 as we record today.
I mean, why not? We did look over the last couple of weeks. We looked at some of the potentials for breakout as we're moving up to test the previous highs for the now fourth period of time here. We had a double top back this spring, up over 2,000. We hit over 2,000 in March of the previous year. And then, of course, July 2020 on the heels of COVID. What we have also talked about is the fact that we're starting to compress up. I think this was something I went into last week, maybe the week before. Rob, I think you and I were talking about this. The idea that the first time we went up over 2,000, we had a pretty healthy retracement back down to around 1675. It came back up, tested it again, March of last year, and we had an even deeper retracement. So we talked about this potential concept that the first retracement is going to be reactionary to the big market move. The second retracement was people trying to do some profit taking, or maybe even looking for a double top and gold turning back down to, 1,400, 1,200, 1,000. But there was some gambling on that second high we hit in the spring of last year.
You said that a lot of people were probably just thinking they had missed it the first time around, wanted to take advantage of it the second time around, didn't want to miss out again. And it did. I think it dropped into the 1300s.
But since then, we've gone up to test 2,000 again this spring. And the retracement we had here recently barely scraped, into the 1800s, low to mid 1800s. And now we're back up here again.
Bullish. Yeah, I like it. I mean, so now from here, the question I think everybody's asking, are we going to go touch that previous high a fourth time, right around 2080?
I think we will. And what's the 200-day moving average? Where's our base?
It's staying down in the mid-19 and low 1900s, so
like
we are separating.
1940, something like that.
And we're separating from that, right?
Yeah.
Which would cause you a little bit of pause. Do we get a small interruption here as those moving averages move up and we come down to touch? Do we break through? Like, who knows? This may be what pulls those averages up aggressively. Do we break through that all-time high, or do we go and set a lower high this go-round, which wouldn't necessarily be a real pretty picture, right, Miles, technically?
I'm going to follow up on the 200-day moving average. Yeah, we had that breakout above it back in October, and then we just had a retest here on 2 weeks ago, on the 13th. So really nice bounce on the 200-day moving average. And I'm going to do something, Tori, just for you. I'm going to be a little optimistic for a minute. I know that makes you real uncomfortable. I know that makes you real uncomfortable when Miles is optimistic. I put some charts together for the guys around the office. We're pretty overbought at this point. So yeah, it probably is. But the question is how much. So I put some charts together this week for the guys around the office because it does get difficult to start speculating on where a price is going in territory that has never happened before in history. So what does a gold price over and above 2080 look like? So what I do is I extrapolate out sort of some future fib levels to where retracements might line up with previous price action. I'll draw it on the chart here so you get an idea of what I'm talking about. And as usual, one thing I always love is when you have multiple things all lining up at once. And if we see something happen where, say, we have a run up over 2100, a nice little breakout, nothing significant at first. You got to test the water before you dive in. Get a nice little breakout here. I targeted somewhere around 2130, and then a little soft landing pullback maybe into the mid 1900s. Now, what that's going to do is that's going to line you up with, what did we just talk about? The 200-day moving average, which will have inched up a little bit, but not a ton over the next couple of weeks, month or two. Sure. That's going to line up with what we just talked about right before that, the fact that with these rising floors, since that second time we hit above 2000, with these rising floors, we do have a inclining trend line that'll line up right about there. And you're going to have some fib levels line up right around there. So if I can put my crystal ball on my head and, Swarmy says, what was it? Hold the card next to my ear, and make a prediction. 2130, I think, is a pretty solid top on this particular move if we get there, if we break into new territory. Little pullback to the mid 1900s, and then you're looking $300-400 from there. I mean, now we're talking actual next leg of a significant bull market kicking off possibly in 2024 and seeing prices in the 23, 24, 2500 range within probably a pretty short period of time. And it's been a while since we've seen a metal do that. In fact, there's a metal that's done it both directions over the last 5 years that I think you guys wanted to talk about today as well.
Palladium.
Yeah, I mean, we have to talk about palladium, talk about a pullback. And I know we tend to skip right over it if we cover it at all. It's an important part of a portfolio at times for us, right,
At
Rob?
times, but not now.
Especially for Mr. Multi-Decade over there. But not now, right? And we've had a lot of clients saying, oh, should I be buying palladium? It's down, now it's down 70% or more. And why not? Why wouldn't you be buying palladium yet?
I just don't trust it. Really don't. I mean, you look at the global supply of palladium, I want to say 40% from South Africa, another 40% from Russia, the balance scattered around the globe. And it's so heavily tied to the auto sector, catalytic converters.
Sure.
The only reason why palladium took off is because Detroit and other automakers shifted from platinum to palladium because it was a third to a half of the price of platinum. And then it shot way over to where it was 2.5, almost 3 times the price of platinum. Whereas you go back 20 years and it was a third of the price of platinum and very spready. I remember buying palladium back in the late 80s, and we bought it for about $80 an ounce. And then it went up to 130 or 120. I'd have to go back and really look at the charts. And so we're like, okay, that's a quick gain. Let's sell it. And we could only capture about $85 an ounce. The spread was enormous.
We're seeing that now. If you look closely at the difference between the bid and the ask price, it is very spready in the wholesale spot price.
Yeah.
Just in the future spot price, much less the wholesale physical market. And I don't trust it either because I don't care about what the price is. I care about its relative price to platinum.
Right.
We talk often about the ratios, and what you just described is the ratio play. And so we're still waiting. I mean, we're going to do a little victory dance when they are at parity with each other. Miles, you were saying, I think in the futures market, platinum has stayed relatively the same, but palladium got down to around 950, almost parity already. So maybe by next week's show, we'll do that little victory dance.
Yeah. And we'll record it and we'll put it on the YouTube video. Tori doing his little Irish jig.
Yeah.
Well, I mean, the frustrating thing that we all dealt with was coming out of our palladium positions, going to platinum, and then watching palladium continue to increase.
Right.
And by that point, we were already out at a parity to platinum, most of us, you know, and then some of us got out a little bit later when we captured about a 50% gain. And then it just continued to climb.
But a lot of clients got more than a 300% gain in ounces going back into platinum from the palladium. Now, it was an outlier event,
right,
to where palladium not only hit an all-time high, but it hit an all-time value high in terms of that ratio.
Versus platinum.
Platinum. We'd never seen the extreme before, much like what the gold-silver ratio did in 2020 post-COVID. So there's always outlier events that you leave a little bit in there for just in case, and we'll be watching that with the gold-silver ratio, which also, by the way, has had quite a move. I mean, remember about 12 months ago, 14 months ago, we were back up at 95 to 1. Today, we're at 81 to 1. So, Miles, let's transition to silver here a little bit, because I had a client today say, well, my gold's doing well, but silver's not doing anything. Actually, silver has outperformed gold. Gold's up 3.5% from the last show, and silver's up over 5%. And fun charts to look at here.
Yeah, the 3-year chart on silver is very interesting. I don't know if you can pull that one up, Miles, but we've got that wedge formation, what they refer to as a pennant. And silver is just peeking above the tip of the pennant, just over $25 an ounce. You care to put on your Kreskin turban again and make a prediction about silver, Miles?
I think we're dating ourselves with the references.
Yeah, I think we are.
Yeah, the silver price, silver is just frantic gold. I mean, the highs are higher, the lows are lower, the swings are bigger, the percentages are greater, but it's really just frantic gold. Now, what silver hasn't done is we haven't gone anywhere near the all-time highs, and gold is scraping the surface. So the comeuppance is due. I think a couple weeks ago, maybe a month or two ago, I know we talked a little bit about how silver does tend to, during the big bull market moves, especially the types of bull market moves that pull gold for political, economic, geopolitical reasons, silver always plays catch up, because when hard times hit, people turn to gold first. That's just the reality.
That's right.
However, when silver wakes up, you definitely want to have 20, 30% of your metals position sitting in a silver position.
Oh, it'll catch up. Yeah.
Yeah, because it will catch up. So short term, Rob, what you're picking up on, we've had a lot of trading ranges in silver, and specifically this 3-year wedge. So going back to 2020 bottom and 2020 top, nice compression all the way through, up and down, multiple hits on both sides. But it has started to work its way out of it here, and we had a really good little sort of lift-off move here over the last couple of weeks. So silver back up in the 25 range. I mean, it's nowhere near the 2020 highs. We've still got $5 to go. But $5 can happen really quick in silver. 20% move in silver doesn't have to take 6 months.
That's right. And you touched on it a couple weeks ago again, saying it's almost like filling the gap. You described this gold move potentially going just over 2,100 because there's not a whole lot stopping it here if there is a breakout in place. Same thing with silver. I mean, you wouldn't expect there to be any significant resistance if this is a breakout until you get where? 27 plus?
Yeah, 26, 27, probably 26 and change is going to be the last stopping or potential ceiling you see between here and 30. So I only think we're $1 or so away. And then once we get past that, yeah, no reason not to go at least to the 2020 highs.
So whether we see those moves or not, I think in large part is going to be dependent upon the underlying fundamentals, kind of really 4, I'd say, key fundamentals, between the dollar, bond yields, certainly interest rate hikes and pausing, and then geopolitics, like the strain in the global geopolitical scene. But
right, and I would also add to that the surprising drawdown on the Fed's balance sheet. I would have bet money that the balance sheet was going to have increased. It's actually gone down. So that doesn't line up with what we see happening. I don't know how they did that, but keep going. Sorry to interrupt.
No, I love it because that's a very quiet, almost like a covering their shorts type of activity that's off the radar, out of the news. And we'll get updates on that. But Miles, I think it's certainly worth throwing the dollar chart up here because the gold investor ought to be very encouraged by the fact that those 4 fundamentals here are in favor of a continuation of this climb in price, right? So let's start with the dollar.
Okay.
Sure. Dollar down 4.5% now from the high. Well, not the high, but from the October high. So the bond issuances, I don't think have gone over well. People are with the expectation of rates holding for the time being. I think the dollar's going to have to find sort of reality mixed in here. Obviously going from 90 to 115 over the last 2 years was a little bit of an exaggeration. Having a little bit of a pullback here made a lot of sense at the time. Since we just keep coming back to 200-day moving averages, the dollar dropped below, or at least the dollar index is now back below its 200-day moving average. Last time it dropped below the 200-day moving average, that was on December of last year, and it stayed there till August. So we had a pretty significant period of time where the dollar continued to decline, had a little pop back up above it. But, like I kept saying, I was hoping for like 108, 109, 110. Like I didn't think it'd get back up to the old highs, but it fell a little bit short of that. And it looks like the dollar may be on its way back down again, depending on what the interest rate hikes are going to be. And the interest rate hikes aren't going to have the same effect that they did a year ago.
Well, and they've been dropping. I mean, the 10-year has fallen from, it was approaching 5%. It's down to around 4.25. And like Tori was saying a minute ago, those rising bond yields were creating a lot of headwind for gold, just like the rising dollar was creating a lot of headwind from gold.
Sure.
And you have the geopolitical world scene, which is becoming increasingly unstable. So, Tori, I think your assumption is correct. I think there's a lot that is favoring a strengthening gold market as opposed to another pullback.
Yeah, and we're always one news event away, right? In
Yeah.
any one of those four areas, there could be something that causes a dollar rally, which could be an equities market crash, right?
Right.
There could be something that causes pacification in the Middle East. Right now there's a ceasefire. That could ease the geopolitical scene. Bond yields, treasury yields could start to climb again on some uncertain piece of news. So we don't know, but to me, it's very interesting that all four of those are going in the right direction. And that inverse relationship between the dollar and gold has been very, very consistent.
Yeah.
Just like what, Miles, you just pointed out. I didn't even think about that. The fact that it's below the 200-day, and we're talking about gold being over the 200-day. Again, that's that mirror-like relationship between those two charts. And so who knows what it's going to be, but I do know that it's going to go where Miles's charts say it's going to go in the timing that the news drives it. It's just ultimately going to end up right where those charts point. We just don't know what the news is and what the timing is and what the exact fundamental is. And I do that in jest to Miles, but it's proven to be the case over and over again.
Yeah. Hats off to you, buddy.
Thanks. I have my moments.
Yeah.
Humility and how I attained it.
Yeah, right.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. If you liked what you heard, head on over to our website. We can be found at McIlvaney.com. We're also on Twitter at ICA Gold or Facebook at McIlvaney Financial. And as always, if you'd like to discuss your personal portfolio with one of the advisors here at McIlvaney Precious Metals, give us a call. We can be reached at 800-525-9556. Thanks for listening. Have a great week.